Hey guys, what's going on? Abdel Khawatmi, Paramount Residential Mortgage Group, your favorite mortgage lender. What I want to talk to us today with Tuesday tips is actually in regards to the different scoring models and what's currently out there, what mortgage lenders tend to use, and what are we typically obligated in order to do when you're qualifying. So credit obviously plays a major role when you're looking to qualify for a mortgage. There's a lot of different credit score models out there, such as FICO Score 8, 9. New ones are slowly coming out that are starting to include rental payments. You also have the opportunity of what's called through Experian Boost, adding some type of credit onto your score, such as utility bills, cell phone, and things along that nature. Now, there's a lot of different types of credit. So many different ones out there. There's some that are geared more towards credit consumers that they can pull through themselves through credit monitoring. You have Credit Karma. Credit wise, a lot of major credit card institutions nowadays are also putting them out there for you to be able to utilize. But there's actually about 16 different credit scorecards that are actually out there that exist today with the FICO score. The most common one usually is that FICO score 8 or 9 model generally. Now, what I want to talk to us today, again, I always have my slides available to us. If you guys are interested for yourselves or for your clients, please feel free to reach out to me, and that'll give us a better gauge in regards to our credit risk and what we can do. So now we're going to dive into specifically in regards to the mortgage industry. The mortgage industry, for example, is generally mostly concerned with past mortgage history more than anything else, right? So we want to take a look at if you've owned a mortgage, especially right now with COVID, we're going to start seeing a lot of different changes and a lot of different adjustments that's slowly going to start happening with the mortgage industry because of COVID. COVID has created a lot of different situations in regards to clients not being able to pay their mortgage, putting their mortgages in forbearances, putting their mortgages in backing that out to the end of the loan. A lot of different recommendations that we have where you either have to, if you're in forbearance and you're looking to get an FHA or conventional loan, do you have to wait 12 months or do you have to pay everything that you owe, bring it back? So some of the things that we're going to look for, and already a lot of adjustments have been made by Fannie Mae to help accommodate these, such as adding, as of September 18th, 12 months of rental payments that can actually help you qualify for DU. And then you also have the opportunity with credit scores. Fannie Mae has actually allowed the consumers where usually you take the middle score of each borrower. So if you have two different clients who are actually qualifying for the mortgage, let's say a husband and wife, or any family member or cousin or whoever the cosigners are, you actually have the opportunity to take now the average of both of the middle scores, when before you always used to have to take the lower of the two. So a lot of different adjustments that are continuously keep going on with credit scores. I'm always going to do my best to keep you guys educated. But again, there's a lot of different algorithms out there, and the two main ones that we're going to discuss today is that FICO score and a Vantage score, which a lot of consumers tend to look at when they're looking to qualify for a mortgage. And it is definitely not the case of what mortgage lenders are obligated to use. So why does your credit score that you look at is actually different? So the mortgage credit score, it's similar to an auto loan. When you go to car dealerships, they generally pull what's called an auto industry option score. As opposed to mortgage lenders, we pull a mortgage industry option score, or generally just pull a regular credit score in regards to FICO. So FICO, guys, is a business analytics software company. It actually started in 1956. It started by two different individuals, Bill Fair and Era Isaac. So that's where the algorithm, obviously, or the abbreviation of FICO comes from. Credit scores can range from 300 to as high as 850. Lenders like myself are obligated to gauge that based on the client's credit worthiness. A lot of different restrictions that are put in place, such as an FHA loan, you can go as low as a 580, as well as a VA loan, government loans. And then generally with a conventional loan, it really depends on the client's case-by-case basis, but usually you want to be closer to that 700 and above to really put you in a position where you're not being risked and forced to pay discount points to lock in your interest rate. Fannie Mae and Freddie Mac actually first began using FICO credit scores to help determine whether a client, American consumers, can qualify, and then eventually was sold to the companies in 1995. The most widely used credit score, again, guys, like I said, is FICO score. FICO score, once again, is a mathematical model. We're going to go over the specific statistics in regards to how each thing is gauged, from payment history, utilization, the amount of credit, how many inquiries, and so on and so forth. So there's three different types of credit that you guys might have heard of through FICO with credit scores. And the three bureaus that you have is Experian, Equifax, and TransUnion. Now, each of these FICO scores actually are based on information that the credit bureau has on files about you. Now, credit reporting agency actually consider this data from the credit reports that come from the creditors themselves. Now, your credit score, once again, can be different at each credit reporting agency. I would say almost 99% of the times, probably even 100%, clients generally have a different score on Experian, Equifax, and TransUnion. And I can't even put a pulse to it as to which one is generally higher or lower because it's really hard to determine. Some of my consumers have a lower credit score on Experian, but other ones have lower credit score on TransUnion. And it really is just generally based on the number of accounts you do. In order to have a credit score, you must have at least 1 or 2 accounts open revolving for a minimum of 6 months or longer, and at least 1 account that has to be reported to the credit agency. That's huge. I cannot tell you how many different clients I run into who say, I'm going to add, for example, my mom or dad onto the credit report, or my younger brother, or whatever the case may be. If they do not have any revolving accounts, credit cards, car notes, installment note, or anything of that nature, they will likely come up on our end as something called not scorable, meaning that consumer does not have a credit score, he's not scorable, and the main thing that I always see is that it does not have any credit that is currently open or revolving for a minimum of 6 months. When it comes to a Vantage Score, so Vantage Score, guys, is unveiled again with the 3 different bureaus. It came out in March 14th of 2006. The most common entity that uses Vantage Score is Credit Karma. Credit Karma, again, now those scores are different. Vantage Score scores can be as high as 990 as opposed to FICO being 850. That's the major difference. So 850 as high as FICO, 990 on Vantage. So you may be a 700 credit score or even a 750 credit score on a Vantage Score, but remember, that's out of 990. So if you're a 750 credit score on Vantage, that means you're close to 220 points away from a perfect score, okay? As opposed to FICO, you're only 100 points away because it's out of 850. So big thing to look at generally from what I've seen based on experience, your credit score based off of that is a lot less. Credit Karma, generally your credit scores is going to be higher than what it would be on FICO. And then they have different scoring models where they range them, A, B, C, D, and F. A, 900 to 990, B, 800 to 899, 700 to 799, and so on and so forth. So you guys can see your Vantage credit score is going to be a lot different than it is in FICO. Another major difference is how the algorithm itself is calculated. So payment history for Vantage Score is almost 32% of your credit score, as opposed to FICO, it's 35%. So that's one difference. Utilization is a big one. 23% is calculated for a Vantage Score, as opposed to only 15% for your FICO. Your balances, 15% for Vantage, but take a look at this one, 30% for FICO. That's almost double. So if you have credit scores and the revolving accounts that you have are very high, your best thing that you can do is pay those balances off close to that 15%, honestly even closer to the 0%, which will really put you in a position where your credit scores will skyrocket because those utilizations have been dropped dramatically. Recent credit scores is 10%, very similar to FICO, which is also 10%. And then another small one that they have is actually available credit, which is 7%, as opposed to FICO score does not count that. If you guys add all of those together, it's going to equal 100%. But as you can see, Vantage and FICO actually score a lot of them differently. Now, when FICO is calculating, again, I'm going to repeat it. FICO does 35% for payment history, 30% for utilization. That's almost 65%. Literally close to, what's that, almost a third of your payment history that goes to 35% of payment history, and then you have 30% of utilization. And then you have 15%, which is the length of your credit history, 10% for credit inquiries, and 10% for your credit mix. Big one. Payment history. What do we think of? It's all about how you've paid your history on time. Lenders are obligated to take a look at your payment history, and they break it down into 3 categories. The severity, so how many times have you been late? If you've been late once 30 payments, it's not as severe as if you've been late almost 90 or 120, slowly approaching collection or a charge-off. And then you also have collections, tax liens, and foreclosures. Those are a big killer of credit scores. If you have something on your credit report that is currently being reported as a collection or a charge-off, it is super important for you. You have a right as a consumer under the Fair Credit Reporting Act to dispute this information on your own. If you go ahead and dispute this information on your own, you have the opportunity to argue, so to say, and see where the creditor has validated that the information that you're paying is reporting accurately and correctly. And then frequency. One late payment is a lot better than having multiple late payments, because it's when we look at credit reports and we pull it through a platform called Credit Plus, which is very common in the industry. When you have a late payment or a collection or a charge off, it literally comes up in black bold, basically stating this client had late payments, boom, 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 boom. And that is one of the major differences of how your credit score is calculated. Utilization, 30%. This is again based on FICO. Big one. That means that 30% of your credit score is how you are using your accounts. If you are maxing out your credit cards, 99% of the time, your score is going to be on the low side because you have proven to the banks that you cannot. How are you maxing out your cards, but then simultaneously, in layman terms, going and asking for more money? No lender or creditor is going to feel comfortable giving you that money, mainly because you're already maxing out what you currently have. Length of history. 15% of your credit score is based on your length of history. So when you're new and you're young, or you just came into this country, or whatever it is, it's a third largest aspect of your credit score. So if you're a young person, student, or anything of that nature, one of the key gimmicks that you can do is get yourself added, or I shouldn't say gimmick, it's actually a very helpful tactic, being added as an authorized user on your parents' credit card, on a family's credit card, of course with their authorization. This is going to help you not only get a multiple accounts, it's going to reduce the inquiries because you don't need to be added as an inquiry, and it's going to give you that benefit of the history as well. Then you have new credit. Speaking of that, now most of us have started when we were first getting started as youngs, is that we walked to the bank and got what's called a secured credit card. A secured credit card is offered by a lot of large credit card issuers. And then it's, for example, it's basically you giving your money, $300, $400, $500, you can give it, and the bank opens a line of credit for you based on your $500. This will now report to your credit. So now you've established yourself as a credit. And you guys remember earlier, we were just talking about what is the types of credit and how you can build it. This is a major one that you could do. So the secured credit card and the authorized user, it's going to go into how much time you've had with those accounts. Now, are you new to credit? If you're somebody who's new to credit, there's not much that you can do to improve your credit score, right? So you don't have credit. So a newly added account is actually going to reduce your potential score, but again, it's going to be for the short term. As I mentioned before, and I'll repeat it again, what you can do is get yourself added as an authorized user on a family member's account that has long standing, and of course, make sure that their utilization is not going to be high. Now, a huge myth, closing accounts. If you're looking to close your account, you have to understand this will likely injure your credit score. Even if it's not being used, it will hurt you because now your utilization is likely going to increase because you no longer have that available credit limit there, even if it's at a zero balance. You're also going to reduce your credit history, right? Because if you've had an account for a very long time, 5, 6, 7, 10 years, and then you close it, that is no longer counted. Now you're stuck with having other accounts that have been at a shorter time frame. So big myth, don't close your credit cards. Always keep them at a very small balances. Keep an eye out for them that they don't close by themselves. Now you also have something called rate shopping. When it comes to your credit score, consumers have the opportunity to actually rate shop, which basically means if they're going to a car dealership, they have the opportunity. Generally, car dealerships will call shotgunning your credit, where they'll send it to multiple banks. Previously, it does show up on your credit. It will likely injure your score, unfortunately, but it's very temporary. So it puts you in that temporary hiatus of your credit score. Lenders, same exact thing from a mortgage perspective. You have the right to make sure you're working with the right mortgage lender. Now, interest rate's a big one, but remember, guys, when you're looking to qualify for a mortgage, and I can say this from personal experience, internet lenders are great. They generally compensate their loan officers at a very small spread. They then thereafter use whatever that spread they're not compensating their loan officers to get you the best possible interest rate. A lot of different factors that come into play when it comes to comparing interest rates. But remember, interest rates is one factor. Let's also keep in mind your level of service, the communication, your follow-up, and you not being potentially exposed to losing the deal because a lender is not communicating. Super important to keep that in mind. Inquiries. When you're looking to acquire, now if you are going to be shopping, you're going to have inquiries on your credit. You want to be careful with the inquiries because they stay on your credit report for 2 years. A credit inquiry, again, it has a small impact on your credit score. It ranges based on the risk factors from each consumer. But grouping those inquiries all together, if you have multiple, are going to hurt your credit scores. Inquiries, again, have a greater impact if you have a short credit history and don't have a lot going on. If you have an extensive credit history, it will definitely not be that much of a setback as it would be for somebody who's brand new. And then the last one is the types of credit. So there's a 10% calculation based on FICO, based on the types of credit score. Both of these models want to see a healthy mix, right? Both FICO and you also have Vantage Score. Those take a FICO mix. So what do you want to have? You want to have at least a minimum of 3 different credit cards revolving. Okay, they can be secured, unsecured. Auto loans is a big one too. You don't want to have good credit scores between 700 to 749. Fair is between 650 to 699. Poor credit score 600 to 649, and bad credit score anything below 600. Again, this is just the statistics of what they basically look at. Lenders, too many different factors that come into play that will calculate. So you can have somebody who's a 690 credit score but have extensive history, and have another consumer with a 750 credit score who might be brand new. A lot of different factors and compensating factors that desktop underwriting through Fannie Mae or loan prospector through Freddie Mac will take a look at and may potentially favor that 690 credit score consumer because of the massive mix of credit scores that he has. So again, some final tips, guys, and I'll let you guys go. The first thing is always pay your bills on time. Huge. 35% is based on your paying your bills on time. 30% is utilization, so you got to keep your balances super low. Have lots of positive credit on your report. If you don't have, get added as an authorized user to give you that good credit mix. Again, have open at least 3 credit cards, preferably. Again, it really depends on your personal recommendation, but 3 credit cards is what I've seen is the way to go. Reduce the number of installment accounts that you open up, and then simultaneously, if you're new to credit, get yourself added on, again, as an authorized user, and don't apply for too much credit at once, okay? If you guys have any questions, I hope this video was helpful. Please feel free to reach out to me. As always, I have my PowerPoints available and ready to fire out to you guys. Again, my name is Abdel Khawatmi, Paramount Residential Mortgage Group of the Mortgage Plugs. This was Tuesday Tips with your favorite lender, and I look forward to catching you guys next week. Thanks, guys. I'll catch you guys soon.